onto how some of the latest developments are being looked at, whether or not we're feeling earthquakes or whether things are starting to get back on solid track. In conversation with Saurav Majumdar, editor Business Today, I'd like to invite on stage Niranjan Hiranandani, co-founder and MD Hiranandani Group, and Dilip G Piramal, chairman VIP Industries. Welcome, gentlemen, and thank you so much for being with us here today at the Business Today Market Today Summit.
Global headwinds, inflation, rising interest rates, and generally an era of uncertainty, which we discussed even in the previous session. But now we have two very well-known industrialists with us to give us a sense of essentially where this coming year and beyond is going to, what it's going to look like. There is the first the first milestone is on February 1, which is the last full budget before general elections. So we'll talk a little bit about that. And of course, beyond that, in terms of what the economy is looking like, what are the headwinds essentially which we see, and how India Inc. and the Indian economy can sort of overcome some of those. So I'll start first with Mr. Hiranandani. To give us a broad sense of where you see 2023. We've already talked about, there is a lot of discussion around a possible rebound in China after the last year, and also, of course, global recessionary challenges coming up. In a sector like yours in particular, and in general, as one of the country's foremost industrialists, what do you see as 2023 looking like?
Thank you. Looks very exciting to me. I think it's very positive too. Look at the numbers that float around. 6.2% as compared to any other Western country, which looks very sad and downwards. The challenges which you see in Europe with the Russia-Ukraine war, where you see a lot of difficulty there. I think overall the sensitivity of the West, which has now almost removed 100,000 people from their jobs as a cumulative number. Somebody said it's 50,000, but even 50,000 for the US in one shot is pretty high. I think all these things definitely indicate an international challenge for all of us across the globe. However, we're seeing some differences in India. With the demographics that we have, with the kind of thought process that we have put in terms of geopolitics, I think we have had several wins. Number one win, we were able to get petroleum and gas from Russia. It saved us 35,000 crores as an upfront amount, which would have bought from the open market. I think that made a world of a difference that happened. We have been able to see that our markets itself have remained high internally, both in terms of the stock markets and the other markets in terms of it. Real estate volumes have grown between 15 and 20%, depending on the type of sector that you're looking at. So all in all, we have seen a growth path which has been unprecedented, so in spite of that. And this is in spite of the fact that interest rates have gone up. Home loans have gone up from 6.5% to 8.2% on an average. So obviously those are the headwinds that you talked about. But in spite of that, home finance has gone up 20% across the board. So that's a wind that you see blowing in the thing. Second, we thought that COVID would be a negative to home buying. It's been the reverse. People have actually gone in for homes and home loans. In fact, 22 has seen the first time in my career that I've seen that the upper segment of homes has grown faster than the affordable segment. Though, of course, the affordable segment is a much larger segment as the total. But even then, this thing has never happened before, that the growth of the higher segment has grown faster. All these things put together shows us that we've been able to be resilient to the international move, and one of those times where we haven't seen it. As far as tech is concerned, there is a huge concern, and I think that the market sensitivity is also indicating that. However, there are contrarian views, and this is what I would like more than anything else. The contrarian view says really that the moment the West has a problem, they want to offshore more work, because obviously because of the cost arbitrage. And if that is happening, then I think we won't have a problem in the tech sector as much as we would do it. Infra has grown hugely, and that is with 35 kilometers of national highways per day, and the inauguration in Mumbai by the Prime Minister and do it. I think we are seeing a different India completely, more resilient, more there, 6.2%, very positive growth. I'm looking at 2023 with a very positive angle. Yes, I do believe that the budget is going to be very critical for us. We are hoping that in this budget, 1 year before the final budget, which would come next year before the elections, we would be able to see a further positive impact on investments, because that is something which is very badly needed. I know the government is investing. Disinvestment, according to me, has been too slow. I think a faster disinvestment would have definitely helped the market, and the money being used for the purposes of putting up further infrastructure, airports, roads, waterways, ports, all these things put together. There's one number which I want to put down across to you. The logistic costs in India is around 13%. So anything that you buy, 13% is the cost of logistics. Contrary to that, the logistic cost in China is close to 7%. So we have a 6%, China has an arbitrage for every item of goods that it exports or supplies to the local customer. With the national highways, with roads, with transport, airports, all this, if we can bring this 13 down to less than 10 in the next 2 years, that itself will be a 2% GDP growth which will be added to the economy simply because of investments into the infrastructure. Yeah. So very positive.
That's clearly the government's objective also in terms of logistics, like you rightly said. We'll come to details a little bit of the budget a little later. Mr. Piramal, you are in a business which is directly related to the consumer in that sense. What is the sense you get? We talk about India, the domestic market being one of the key strengths which will sort of tide us through these challenges which are global. What is your sense, and how do you see the kind of headwinds and the kind of way in which we can sort of tide over those challenges, banking on the domestic market?
I am a confirmed optimist, and I have been saying since '92, since the reform started, that there is only one way that India can go, and that is upwards. But I would say now, for the first time in the last 5 years, 6 years since this government has come, that we have never seen an India in this light, and what we have experienced in the last 5 years, and particularly with China now on the decline. China is, people sort of say China economy is finished and all, but that's all rubbish. China is the second largest economy in the world, about 6 times the size of India. So even if China grows at 3% and India grows at 6%, the overall input they have, the growth is much more than what happens in India. But nevertheless, China is on the decline, which is a big change for India, and we are getting that advantage. We have never seen that normally when such a large country, large economy like China goes down, it has an impact on the world because demand goes down. There's such a big part of the buying and selling. But for India, I think it's an advantage because we are mainly buying from China. So we should get things at a slightly cheaper price. I mean, our main imports are either consumer goods from China, consumer and industrial goods from China, and of course, crude oil. So if China demand goes down, then crude oil also relatively it has an impact. And of course, at the moment, even Europe and all are under strain. So this sort of juxtaposition of India with the rest of the world is their problems are not really affecting us so adversely, I feel. But in fact, it is to our advantage. We can take advantage, and especially the low manufacturing industries. I mean, I am in the luggage manufacturing, which is one of the, probably the smallest category of anything. But even there, I mean, China was the world's capital of manufacturing luggage, like so many other consumer goods. Unfortunately, I mean, it's a very labor-intensive industry, but all the once consumer imports were allowed. I mean, a lot of people don't remember that consumer imports were totally banned into India up to the year 2001. So we had to make everything what we sold in India. And so after that, after the imports were relaxed, and now in the initial period the duties were about 85%, but very soon, within 4 or 5 years, they came down to 10%, which I think was very anti-Indian. I mean, though it benefited me personally, but I was dead against it. That, I mean, it was really killing Indian industry. But anyway, so now luggage manufacture is taking place in India. We have set up a very large factory in Bangladesh for soft luggage because India is still not as competitive as Bangladesh. You know, India manufacturing, unfortunately, at the lowest end, low wage goods, is very poor because our wages are still very high. The minimum wage is about 18,000 rupees. Whereas this industry, most industries at that level, which are not technically, which are sort of labor intensive, would sort of, fair wage would be about 10,000, 12,000, which most Indians are not even earning that much in the unorganized sector. So, coming back to the consumer goods, that the outlook is very good. I mean, especially I'm in a very extreme industry, which is very badly affected by the COVID. I mean, for the first year, our business was zero because I'm in I make luggage which is dependent on the travel, on travel. So that was virtually nothing. And in fact, now there is a rebound and people are doing that revenge traveling and all that. But then again, we are having a problem because Chinese supplies are not there. And there's a problem of supply. So we're not able to meet, just like the hotels and all, and the occupancy is complete. Even airlines are absolutely running at more than 90% occupancy, which is which means that there are a lot of rejections. A lot of times people don't get tickets. Prices are high. And same thing for hotels. But overall, the outlook is very good for the consumer industry. And I think there are very few, there are some problems, but not too many.
Interesting, Mr. Piramal, that you talked about manufacturing and, how India is still not competitive in that sense with even countries like Bangladesh. But let me come then to the to the whole idea of PLI, which is being seen as a game changer in many cases. I will ask both of you this question, and I'll start with Mr. Hiranandani. PLI is being seen as the government as a game-changing policy. A lot of industry does seem to agree with it. But there is a section which also believes that is there genuine value addition happening in PLI, for instance. Now we talk about electronics having been a major gainer, but that's one. Now there is a view that MSMEs particularly need more help. So, and it's a form of subsidy. So, which is again not a great thing to do. So where do you see the whole PLI debate, and do you think it's really benefiting and can change the game for manufacturing in India?
I think it was needed. I think it was required. I think it sent the right signals through the world that India wanted to get into the manufacturing side. And actually, it has made a difference because all the other. Number two, the states have gone into competition of trying to see that they come to their particular state. And I think it will be absolutely imperative. The next stage of this is, I think, more interesting to see. For example, the semiconductor side. And I think that is going to make a world of a change in terms of how we get into that industry. So, very positive. PLI is working and it's definitely making a difference. Yes, there is a contrarian view. I can even give that contrarian view to you. I can share that with you. We don't see that the investment in PLIs are necessarily in terms of employment generation. So we have a lot of other sectors where we see that if investments came in those sectors, we would get much, much more employment per rupee of subsidy you gave. So for instance, let's take the real estate industry. The number of people employed as a multiplier to the manufacturing industry is only 100 times more per rupee of person or per lakh of people. You will have 100 times more people employed than a factory. And in the good old days, if you had an automobile manufacturing plant, on an average, you'd get 5,000 workers. Today, it's fully automated. You'll get 500 workers. But in a construction, real estate, infrastructure project, you will still get 5,000 workers who are getting it. So it's an employment. So like textiles, tourism, real estate, these are the sectors, infrastructure. In these sectors, the employment is higher. So I think a rupee subsidy there would give you much bigger employment. I'm not against the PLI, I'm for it. But what I'm saying is that they need to equally bounce off that the benefits to be given to other sectors where the employment generation is more, and I think that focus is required. So if you give some small benefits in the real estate sector, for instance, the number of people who would be gainfully employed is going to just increase beyond imagination. And I think that is the kind of, or tourism, for instance, that also I think is a multiplier effect which is unimaginable. We have more tourism tourists going to Dubai than the whole of India. And that's just one city, state. So, and can you imagine the possibilities in India that we have with the number of airports, destination, religious tourism, destination, sun, sea, Himalayas, all the other things combined? I think there are so many sectors which equally require help in terms of it, which are employment generating.
Mr. Piramal, your sense of PLI, since you spoke about
I think, let me also add, let me expand on the changes that are happening in the last 5 years. I don't want to I'm not at all negative about the manufacturing industry. The only area where manufacturing really suffers and is probably I don't see any solution to that is in the low-wage goods industry, because India is a democracy and I don't see any government changing that policy, and there is too much of pressure. So, but today what has happened is that we are at the bottom of the pit as far as any manufacturing country goes. I mean, there are a lot of African countries which are poorer than us, where the wages might be lower, but they don't have that sort of infrastructure. So if you really go into a manufacturing scenario, you see which are the countries which will compete with us in this low-wage goods sector. Is Bangladesh, Vietnam. Indonesia per capita income is over $3,000, nearly $3,500. Nearly double of ours, slightly less than double. So Indonesia also is in a different league. So there are very few countries, but that is one area where I feel with such a large population, we still, it is, when things went to China, China was poorer than India or as much as India, and look at what they have done, but they are not a democracy, so they can rule that. So PLI is very good. And there is, in fact, I was watching one debate on television where I got some input that the opposition was saying that government has spent so much on subsidies and all that, whereas the government spokesman said that whatever we have spent on subsidies, in 1 year we will earn more than that by taxes and all, even on this Apple and some other things. So there are, and in the beginning you have to subsidize, you have to help. Look at China. How do you think China has grown so much? Because their infrastructure is done at a very low cost, and the amount of money they have spent on infrastructure, why this logistic cost is so low, because all that investment has been made by the government.
So we are running out of time to both the panelists. I just want to round off this discussion by, in 1 minute, since the budget is upon us, tell me 2 things which you would like the budget to do immediately, so that we get back to the growth path in right earnest. Mr. Hiranandani first.
And the highest marginal rate of tax is on an individual at 42%. It's grossly unfair. So if I'm a sole proprietor, I must become a partnership to make it 35%, and I must make it a limited company to be 25%. I think this arbitrage is too high. I think it needs to be corrected. Number 2, you need to focus on things like home loans. You have had the tax deduction at 2 lakhs of rupees 12 years ago. The prices have gone up, and obviously this standard deduction needs to be done, and people are buying, young people, middle-aged, older people, retired people are buying, needs to go up to at least 5 lakhs of rupees in order to make that. And the loan to value, which is 65%, 70% for normal loans, and affordable segment 90%, and the margin between affordable is only 45 lakhs. In Mumbai, you can't get anything at 45 lakhs. I think that loan to value through the RBI, through the central government, I think needs this change. If these things change, the multiplier effect in the economy is huge. And the unfairness of 42% is unbelievable. And nobody is talking about it.
Mr. Piramal, your 2 wish lists.
I fully agree with what Niranjan is saying about the 42%, but I don't think there's any chance in this political scenario. Today you have all these foreign think tanks saying that the rich are becoming richer and the poor are not going anywhere. They say the poor are getting poorer, but which I don't think is correct. But poorer also in India are improving. But one has to live with that. And I would like it if the rate comes down, but I don't see anything. And I think the budget has become a non-event, which is very good. You cannot have reforms every year. You have a tax rate of 25% and manufacturing is even lower than that. So I think, in fact, I don't even bother. Today there's not all that old excitement. Earlier, 30 years ago, they'd scrap one policy, change the name of development repair to investment allowance, and again bring the same old thing. It was all rubbish, So now we have a settled thing. It's like the West. I was a frequent visitor to London, and I was there once on the budget day, and nobody was even aware that the budget has come. It's like one of the routine things, which is a good thing, I feel.
But in India, it's still far away.
Because we are not got out of that habit. But what's happening? There's nothing new. There's no changes in the tax rates, or they're very marginal rates, and then there are all these development activities, but there's nothing substantial, which is very good. You can't go on now. GST also. Yeah. Of course, GST is not part of the budget, but you can't go on changing in fact, most of the industrial policies are nowadays outside the budget,
Yes, that's true. So we'll see what the FM does on February 1 and whether it is substantive or it is just one of those things. Thank you very much for your views, and we've just run completely out of time. Thank you very much for being with us.
That was a real express session.
Thank you. Thank you, Saurav. Thank you, guests. Saurav, we're going to have you back on stage. Our next conversation is on private equity investment trends in emerging markets. To take that conversation forward, who better than Manisha Girotra, CEO, Mobilis India, along with Sanjay Mehta, founder and partner, 100x.vc. A big round of applause, everybody.
So just after that session on the economy, we'll have we have two very well-known people who know about the private markets, the public markets, and the interplay in between, and also about venture funding, private equity, and how this whole game is sort of playing out over the last couple of years in particular. So without much ado, Manisha, I will start with you. You've been an investment banker for a long time. We've been talking about various trends for many, many years. How do you see the private equity and venture capital sort of scenario playing out in India, in particular in the emerging markets and India, in the face of global headwinds? And we'll come to various aspects of that in a little while.
Thanks, Saurav. Can you hear me? Yeah. Thanks, Saurav. Thanks for having me here. So I think, look, private equity and venture capital has become an integral part of the capital flows into our country in the last 10 years. It really started with the IT services sector. As India became the office to the world, I think, and there was very high corporate governance in this company, in these companies, no regulation, no government interference. Basically, they became the darling of the private equity investors. It started from there, and then investors just started to like India more. I don't think that's changing. In 2021, about $65 billion of PE and VC capital came into India. Last year went down to about $45 billion. And don't forget, this is $45 billion when continents like Europe, a large part of Asia got close to zero. So it's still even a country like China barely got any private equity. So I think it's an integral part. It will continue. What's also heartening, and I'm sure we'll talk about it, is the fact that private equity today is able to get exits in India. I remember when I started my career, if there was a private equity investor which invested in an Indian company, we would say, for an exit, oh, let's go to an ADR, let's go to a GDR, or let's find a strategic investor. But today the Indian markets are so deep that you can easily get exits here. So I continue to be very confident that private equity will continue. There are certain sectors they like more than others. As I said, IT services, consumer, they like the whole play on the Indian demographics. But off late, what is heartening to see is that not just private equity, but sovereign wealth funds have come in. The Canadians, the Middle Easterners, putting in very large checks, and they're going across these sectors. They're not just staying in the traditional consumer IT services where exits are very easy, but they're also going into infrastructure, roads, ports, etc. Renewables is a big play. So I think in India, I'm very positive that they'll continue. Emerging markets, I think the countries they like are probably the ones which play the China plus one strategy well, the countries like Taiwan, etc. Beyond that, I think the other countries will struggle because capital is scarce, leverage is scarce, so it will tend to find a home where you can have easy liquidity exits, and that's not too many of them.
Sanjay, you deal with, you are a seed fund. Also, you talk to a lot of these young startups. You mentor many of them, and at 100x.vc, you've sort of funded a lot of them over the last few years. In fact, what is your sense of the funding winter, which is the topic of heated discussion has been over the last 1 year or so? What is your sense, and how are we dealing with it?
I think. Whether funding winter is here or not, but fear is here, right? So everybody is worried about it. People talk about it. I don't see, we have got queues to get vehicles. Automobile is booming, kind of. Malls are thronging. Restaurants, you have to wait. Where is winter? I don't know, right? From a consumer side, we are not seeing.
But
yes.
PEVC funding has gone down significantly.
Yes, definitely. I mean, there are always excesses in the market, right? You will see excesses everywhere, and then it rationalizes, come back. It's a cycle, and when you are operating in this business, you have gone through those multiple cycles. We have seen. In fact, the way we believe is these are the times where the next giants of India will be born, especially in the startup story, right? We'll see across the new unicorns getting germinated in this era. So, I mean, you are not going to, as an investor, you don't miss vintages, right? This is a vintage which you would like to play out, you would like to invest across, create a portfolio, and that's how the whole story works across. You will see on the Series C and D side, yes, the momentum has slowed down. Earlier, we had fear of missing out, which is not there as an investor. We can take our decisions at leisure. In fact, these are the best times where companies can get great talent at a right value. That whole euphoria is off. So Cost of customer acquisition is down because you're not paying to Facebooks and the Googles of the world so much. So in every aspect, this is great time to build a company and also to invest across. You get great deals. So I think it's a great. So from a fundraising perspective, lot of that momentum which was there, yes, it has mellowed down in somewhat bit, but investing continues.
So, Manisha, coming to an investment banker's perspective, we've seen some of the storied startups last year really come to grips with reality in a pretty depressing sort of way in the public markets. So this whole private market valuation versus that in the public markets, where people, where the whole, what would I say, innards of the company are known to investors and therefore the valuation, takes a beating. How does an investment banker like you see it? And do you think there was clearly irrational exuberance on the part of even investment bankers who seem to have advised the clients differently?
So you essentially called me here to beat me up, right? No, look, I think there was irrational exuberance. There's no question, right? There was just free money floating around the world, and basically you just have to have an idea and some execution abilities, and you found capital. So many of my colleagues, young colleagues, quit and joined as CFOs. 1 year into working, became CFOs of these companies, and you can see that they lack the experience or the tenacity to go through tough times. What is happening now, I would add to what Sanjay said, is a good outcome. It's led to a lot of pain. Some of the IPOs you mentioned, that people have lost capital. But the outcome is good, because I think now what capital is doing is following the real businesses. You had Dilip Piramal talk earlier. That's a real business. There's cash flows there. There's a real business model there. And capital will now follow that or growth. It won't just follow anyone who has a business idea and barely has any execution abilities. So I think this is a good outcome. Companies which have, which address a large addressable market, have margins, have a path to profitability, are the ones that will be able to come to the market. As far as, private to public, of course, the fact that these IPOs haven't done well creates some sort of hesitation in terms of deployment of capital. But I think private equity, don't forget, sort of looks at a 3 to 5 year horizon. And when they look at a 3 to 5 year horizon, the way our equity markets and the way the flows are coming in from all over, as I said, it's not just the traditional European and US investors, it's the sovereign wealth funds, the pension funds, all coming in. They can see that the depth of the market is improving. And actually, if you speak to a lot of them, they're happier because they're saying capital is now going into stronger business models. So I think this pain is welcome, maybe a bit discomforting in the short term, but in the long term, we'll come out as winners, and the business models which were actually stronger will be the ones that will sustain, just like in every other sector. I mean, why should tech have froth? Every other sector, the winners have taken it all, right? So tech should have a similar outcome and will have a similar outcome.
So Sanjay, you think the global tech meltdown, which took, which really took the whole world and the private equity and VCs globally really taken a hit, and therefore the impact was felt in India as well. How do you see that playing out, and how long do you think this whole reset period, if one were to call it that, will last?
So Saurabh, if you look into it, most of these discussions or the news are in the public market, right? Which is more of a secondary market. For us, we at Venture Capital, we do primary investment. We invest in the company. Capital goes to build a company. And when we invest across, we are investing for 5 to 10 years kind of horizon. So the kind of sentiments or the emotions which are flowing in the public markets typically don't flow across while we are investing across for that future, right? We invest on hopes while public markets are working on a quarter to quarter kind of results. So it's a very different temperament in the venture capital side.
But Sanjay, there are large venture capitalists who have also taken a big beating because of the kind of problems they have faced both globally and in India. So the large venture funds, you are talking about, the smaller ticket size, but there are large venture funds who are today struggling, and you keep talking about them, you keep hearing about the biggest names who have really been storied investors in some of the well-known companies which have grown. How do you see that? Also on the PE side, it's also a problem where the limited partners will also be forcing people the private equity funds to take a very hard look at some of the new investments. So do you think it's all that easy for us to say that, it's okay, it will tide over in a bit?
it will tide over for sure. India at least is insulated from my perspective. I'm very bullish on India, and I would advise anybody betting against India not to kind of do it. But it's all about your, as an investment, it's all about your risk muscle, right? What's your appetite? Where are you seeing across investing? If you are investing, for a long-term basis, India is the only shining piece within the whole world where you've got so many opportunities happening across. So I'm not at all worried across, even for the large VC guys who are coming at a later stage. Their entry points are phenomenal, and the companies are getting built out. And I'm sure with this signaling which has happened across, the funding winter, the scare which founders have seen across, the fund managers, everybody's alert. Everybody's tightening their belt and trying to see and steer the ship so that the things and the outcome are much, much better across, aligned to possible how the public investors react to the startups kind of stuff. So I'm sure we are quick learners. We'll learn quickly in that sense. And, but there is a mindset with investors, right? Most of them, if you look into it, the fear of loss is more bigger and motivator than, income kind of generating income. So I'm sure these sentiments will correct.
Manisha, you keep having discussions with the largest private equity players who want to come into India. You talked of sovereign wealth funds as well. We recently did a story in Business Today about the dry powder. Globally also and in India, people are sitting on a large amounts of dry powder but scared to deploy or maybe hesitant to deploy right now. What is your sense on that?
So I think, if I could just connect to your earlier question also, I think the funding winter, as you call it, I think we're probably seeing the last leg of it. I think the markets have pretty much discounted all of the shocks, hopefully all of the shocks, the supply chain shocks, the war, China's reopening, which is actually a good thing if China reopens, supply chains reopen, demand comes back, exports will improve. So I personally think the second half you should see more capital coming in, you should see people deploying more capital. And through the whole last 6-8 months, to Sanjay's point, you've actually seen sovereign wealth funds, pension funds deploying capital quietly, right? They've actually even gone and bought into some of the listed IPOs that you talked about, which are doing poorly. They were, said there's a trade here, there's a rebound trade here to be done. But if you speak to all of them, just given what's happening globally, they see India as the only market which is showing growth. You and I debate and agonize on whether it's 6% or 7%. Don't forget the rest of the world, you're anywhere between -1 to 2.5, right? So, and at a scale, right? We're the 5th largest economy in the world now. So I think you'll see deployment. You're seeing some deployment already. You saw a fund like CPPIB, which basically does minority investments, come and take a large majority stake in Renew Power. So that's how positive people are on renewables in India. India has 100 gigawatts of capacity in renewables. China has 10x of that. China literally puts on that capacity every year. So, things like renewables, etc., deployment has continued consistently. When will it become more wider? I think in the second half, with inflation coming down, rural demand coming back, I think you'll see consumer staples, etc., also see higher demand. So I'm quite confident that you'll continue to see capital come into India in larger volumes and values in the second half.
Sanjay, from your interaction with founders, where do you see most interest in? I mean, despite the fact that there is this whole, let's say, pause in funding, what are the new founders you speak to, the younger lot? Which are the areas where they seem to be bullish about? Tell us a bit about the few sectors you see a lot of action coming up.
So investment trends, in the startup early stage, a lot of innovations are happening in the EV space. So there are basic inputs which people see across. Like today, if you look into it, the industry incentives, the infrastructure which is getting created in EV is propelling the whole industry kind of. And a lot of the innovations are happening in the space. Like for example, challenge with saying that batteries are getting fire or something. So there are new innovative battery technologies which are coming, the battery swapping, the infrastructure charging. So that's one space. Next is generative AI has been a big boom kind of. The AI earlier was very different than what we are seeing now. and with everybody hearing about the Chat GPT-3, and it's like a new brave world which is happening across, and a lot of the new businesses will emerge out of those generative AI kind of working. Then we see across a lot of the gaming kind of businesses which are attracting across, while for a lot of the businesses, gaming remains like a non-touchable kind of stuff, but those are massive businesses which are getting created in that space. So, tech is still continuing to take the lead in that sense. And D2C brands have been really emerging. It is like threatening the existing incumbents in that sense, I would say, across a good amount of corporates. I mean, we work with a couple of corporates who are deploying large amounts of capital to get access to those startups, right? They want to be in that, having that seat on the table, see those category defining businesses very near. In healthcare, digital health, a lot of people are...
You're talking about family offices also?
Family offices, definitely, but those were more financial. Corporate venture capital is all about strategic, right? Saying that I would like to be part of those future businesses which will get created. While internal innovation is limited, how do I get those startups to work with the corporate? And that is which is driving quite a lot of significant capital also outside of the traditional VC fund. So a couple of our portfolio companies, we have got corporates who are our shareholders who are on the same cap table. So corporates are having a lot of interest in startups.
You talked about gaming, Sanjay. I must say, you've been one of the very early proponents of the crypto craze in India and otherwise as well. You've been a great advocate of the crypto space. Now, recently at another summit of Business Today's, we had the governor of Reserve Bank making it very clear once again that he is in favor of a total ban on crypto because he says that there is no underlying asset. Now, what's your sense of where the whole crypto world in India and in the emerging markets will be playing out?
Just on the Saturday, we had our 100x VC pitch day. We announced 4 deals in Web3 space. So, I mean, people have a misnomer. In that sense, I wouldn't say anything against the regulator. But the idea is this space needs more regulation than ever before. More people are joining. It's better to have a regulation. Like, for example, people talk about FTX. Now, that was a challenge because there was no regulation. Assuming an exchange having the ownership of an asset, why don't you have a custodian outside? Like no exchanges hold across the asset. The FTX wouldn't have happened. So today in India, if you have a custodian and the exchange, which are crypto exchanges which are separate, things will never happen across. So today we have got taxes or TDS on doing a trade. A lot of the Indian investors floated their digital assets on FTX. There is no respite, right? So I mean various things. If the space will get regulated, it will just boom kind of stuff. So hopefully regulators take a cognizant of this space and see the kind of momentum which is coming across. It will have to regulate it some.
But in India, you don't see it completely dying down over the next few years.
It's impossible.
Yeah.
You can't stop,
you
right?
You need regulation is basically...
That's it. That's the only way how you can build the Web3 or at least manage, be party to it, right? Government themselves have started with their own digital currency, right? And it will evolve across. And we have seen every new areas, right? We never had an e-commerce regulations. Now we have an e-commerce regulation. We never had for Uber, Ola, transport. Some of the instances happen, government comes with a regulation, right? It is always, innovation will always lead it. And then the regulation will follow across. So that's how I see it.
True. Manisha, I'll split my question into two. One is, which are the areas where you see PEs and sovereign wealth funds coming in and, really looking at, particularly in India, which are the sectors you see them really getting interested in, number one? And number two is, do you see, as IPOs also get withdrawn, many of these IPOs which were planned are waiting. Some of them have been called off. Do you see that because of PE exits? Do you see a lot of consolidation also coming up in the next couple of years maybe?
Yeah, I think, look, with the IPO market getting a little lukewarm, definitely, well, there are more opportunities for private equity. There were a lot of consumer, retail opportunities, tech, which basically became unsustainable for a private equity to invest in. Today, all those companies are back at the table talking to them. So that will be something that the PEs will definitely get more active on. I think, as I said before, 2023, private equity will play a much more active role just because of what's happening in the public markets. Exit is not a concern for any of them. Sectors, basically consumer, pharma, whatever plays on the Indian demographics is something that's very attractive. I think what we've done sort of in the last few years is the structural reforms that India has undertaken. We've used technology as such an inclusive tool that we basically integrated Bharat with India. So, you've got 60% of rural India, which basically now through e-commerce, etc., is integrated into the mainstream. Then, you have disruptive technologies like you have ONDC, OCEN. The OCEN will lead to, more disruption with banks, traditional banks. You'll basically have cash flow lending, so that will lead to different fintech models. ONDC will lead to more sellers and buyers coming onto the more formal platform. So all of these brands which you and I don't even know about through rural India will get capital because they have such access and reach and distribution. We hear about a lot of large cap multinationals saying growth is slowing down in rural India. When I talk to people in rural India, they say that's because let's say a Tata Salt is replaced by a very domestic brand which you and I haven't even heard of, and that's now getting such scale. Governance around it because of certain VCs going in, that you will see capital follow there too. So, much wider capital flows will come in, much deeper capital flows will come in, but I think they will definitely follow cash flows. I think the days of just following an idea and just top line and, companies which were just racing to get that growth number because we were all getting valuations which were a multiple to sales, those days are gone. Where's the EBITDA? Where's the cash flow? Where's the earnings? That's the mantra now.
Do you also see some of these IPO plans coming back but in a much more realistic valuation level?
Absolutely. Not just as IPOs, you may just see reverse mergers into listed companies. You may see consolidation into large caps. A lot of the tech companies, as you've seen, the large caps in India, the traditional companies are integrating with them, Reliance, Tatas, Birlas, etc., leading. Because, also online and offline need to be combined for the last mile connectivity. So you'll see mergers. You may see mergers into listed companies. You may see mergers of scale. And then come back into the public markets with a more sensible, scaled-up idea. So definitely, I don't see people saying, look, nobody's throwing the baby out with the bathwater. People are saying, come back with a sensible business model with valuations linked to EBITDA, and then there is a positive outcome.
You agree, Sanjay, that the valuation, craze has now completely gone, and now we will be witnessing a stage of much more realistic valuations overall?
See, as an investor, you change colors continuously. Right? If you say that, okay, I'll be doing this only, and you have no market, right? So, as an investor, you change positions as the market changes its, color kind of, and you align to it. And that's where things are happening across, where the sentiments were bullish, people were able to price, at a different level. Today, the founders understand, the investors understand, and they price it at a much different level. But the underlying thesis of saying that are investors or retail investors interested in new age companies, I would definitely say yes. Look at the kind of numbers what a TV show is getting. Like, it's now touching to what IPL was. It's crazy. It's unbelievable the way people are viewing that. It's a reality show, but the way it is being accepted and people are talking across, including, a lot of those guys who never understood how startups work, suddenly come up to us and ask across, is this how you behave? No, we don't behave like that, kind of in doing a transaction. So it's unbelievable. India, everybody is now looking upon startups and new age company with a much different lens.
We are running out of time, Manisha. I think I'll just ask this question to both of you, but first to you, Manisha. This also brings us to this whole issue of governance. I mean, that's been a recurring theme over the last 1.5 years in terms of the kind of tremendous unfortunate incidents we've seen in some of the storied startups. I don't want to get into names, but we all know who they are. What is your sense? Are startup founders private equity, venture capital is getting much more, tough on these, and what is the way out? Do you think there needs to be a solution of some sort coming together where the funders come together and insist on some kinds of, sort of checklist before they put in money in terms of these companies?
So sort of exactly, I mean, the answer is in your question. Basically, a lot of the investors have got together and they're forcing governance around the founders, forcing professional management teams, a lot of the CFOs, CEO, divorcing the role of the founder from the CEO, having proper accounting firms. I think all of that's being done, and I know of a lot of my clients who are investors who are basically coming together and saying, look, these outcomes have to be forced on the founder, because what was right for the company in the first stage. And always it's not just a governance issue. It's the issue is that what's right for the company in the first stage, the founder doesn't evolve the company into the next stage where you need a deeper management team. So, what seems as governance to outside is basically because the founder is holding on too tight. And the company's basically gone beyond the founder. And I think we, as Indians, didn't actually force these kind of outcomes. We don't have activist investors like the US has, where even the large caps, the CEOs get thrown out by these activists.
It's happening, but not too much.
Happening, but not too. I mean, US and Europe, it's a big business, right? Activism. It's not the case here, but it's happening now. Maybe not as aggressively as in the US, but definitely investors are very clear that they are not going to have the kind of tolerance that has happened in the last 2 years, where the founder basically convinced them that he's invincible and to the company, and without him the business model doesn't exist. I think everyone's moved beyond that threshold.
Sanjay, you see founders becoming wiser now after the hits of last time? I mean, hits in a negative sense?
So I wouldn't put founders in that bucket, because most of them have good intentions. A lot of the circumstances with the board members and stuff, I would take that responsibility where ethics and governance has to be part of the board and driven through that kind of. So I would take it one level up in terms of how active the board is, right? How actively you are working with the founder. And if you have the right questions, definitely founders will align kind of stuff. So ethics and governance has to be part of the board. And it's more responsibility coming to investor, we as an investor, to drive that whole ethics into the mind of the founder or the founding team per se.
Let's hope that wiser sense prevails, and we are again back to seeing startups doing well and new age companies in India doing well, and the funding coming back in good form. Thank you very much for this lovely session. Thank you.
Thank you, Manisha. Thank you, Sanjay. And thank you, Saurav.